This chapter 4 introduces participator forwards and leveraged strategies designed in each case to reduce or eliminate option premiums for the user altogether. The chapter concludes by analyzing the advantages of all these strategies, but also why some of them have become so controversial in recent times. The first strategy of interest in this chapter is one that arises when the yield curve is inverted rather than upward sloping as it has been so far in this module. To create the circumstances that lend themselves especially well to the strategy we wish to illustrate, we invert the yield curve in column D of this worksheet labeled inverted, so that 3-month LIBOR spot is now 6% and each subsequent forward is lower by 10 basis points as shown here. We also assume the loan we seek to hedge is the 5-year loan from the Seagull example, still priced at 3-month LIBOR plus 1%. Note that the inversion of the LIBOR forwards has brought the 5-year swap rate now to 5.09%, as shown in cell T17, substantially below the spot LIBOR rate of 6%. If you do not understand very clearly why this is the case, please review our related but more basic module labeled Interest Rate Forwards and Swaps. The change in the shape of the LIBOR curve also changes, of course, all the cap and floor prices previously shown in our pricing grid, and these are now restated on this same worksheet, as you can see here, on columns O to AA. Note specifically that a 5-year cap struck at the current LIBOR of 6% costs only 62 basis points, given the market's overall expectation, at least as implied by the LIBOR curve, of declining rather than rising LIBOR resets. Now let's examine prices for 5-year floors, anticipating that with an inverted curve as here, and specifically with LIBOR forwards substantially below spot LIBOR, a floor that is struck pretty close to the spot LIBOR level should be extremely valuable. Indeed, we see that a 5-year floor struck at the same 6% level as the 5-year cap would earn a giant 458 basis points, which is more than 7 times greater than the premium for the 6% cap. So one strategy known as a participator, and analogous to one that is commonly used in FX hedging and discussed in our parallel module managing foreign exchange exposures, is to sell this 6% floor but on only some $14 million of notional, so as to preserve for the borrower the ability to reap significant benefits from declining LIBORs, while being protected if LIBOR rises any further from its current level of 6%. you should have little trouble confirming that the premium for the sold floor almost completely equals the premium for the bought cap when the different notionals are taken into account. To summarize, this presents the company with a strategy that requires no upfront premium, protects the company at the current spot LIBOR under any future scenario, admittedly unexpected, of rising LIBOR rates, and still leaves the company able to benefit from any decline in 3-month LIBOR rates for as much as 86% of its original floating rate exposure. The graph appearing here in brown shows the final outcome under this strategy and contrasts it to the original unhedged position represented by the diagonal and to a hedge involving a regular 5-year IRS. You should note especially carefully the very slightly milder inclination of the diagonal on the left under the participator versus the unhedged position, reflecting the 86% exposure to falling LIBOR under this strategy versus, of course, the 100% exposure of the unhedged borrower along the original diagonal. Depending on the degree of inversion of the LIBOR curve, and the inversion can be quite pronounced in emerging markets with very high short-term rates, for example, the 0.14 to 1 cap to floor ratio in premiums may change substantially, diminishing or increasing the notional of floors the borrower must sell to offset the premium on the bought cap, and by extension retaining exposure to any declining short-term index for a percentage larger or smaller than the current 86%. A quiz question will present this fact pattern and invite you to describe the solution. We conclude this chapter 4 by discussing leveraged strategies, for which we return to the 5-year loan at LIBOR plus 1 and to our original upward sloping LIBOR curve. When contemplating certain zero premium strategies, such as the collars we described earlier, companies sometimes object to the sale of a floor at a level that is so close, relatively speaking, to the spot LIBOR level, as in the earlier example where the floor was struck at 5%, i.e. equal to the spot LIBOR. An alternative is to lower the strike of the sold floor, which of course reduces the premium earned by the seller, but to offset that by increasing the notional amount of the sold floor. Suppose the company continues to want the 5-year cap struck at 7.5%, which we remind you costs 82 basis points up front. The company is reluctant to sell a floor struck as high as 5.12% and is more comfortable with a floor struck at 4.57%, which earns it the more modest premium of 27.5 basis points up front. Noting that the floor's premium happens to be close to 1/3 of the premium for the cap, you suggest to the company increasing the notional of the sold floor to $300 million to generate the necessary premium that offsets entirely that of the bought cap, arguing that such a low level of LIBOR over the next 5 years appears far-fetched, especially given the upward sloping shape of the curve, which is indicative of rising rates. You point out that not only is the 4.57% strike of the floor 43 basis points below the current spot LIBOR of 5%, it is more than 130 basis points below the 5-year interest rate swap level of 5.9%, which is arguably the more relevant benchmark for estimating the likelihood of a 4.57% LIBOR over the next 5 years. In exchange, the company would be taking the risk that, if in fact 3-month LIBOR spot should fall below this remote level of 4.57% over the next 5 years, the company would find the bank exercising the sold floor and requesting payment of a net annualized amount equal to 4.57% minus LIBOR, but applied to the full notional of $300 million. This would therefore increase the company's net interest costs potentially quite substantially if LIBOR has fallen far below the strike of this floor. The summary table for the outcome under this strategy appears here, and you should note in particular the formula now turning red in the bottom left cell, which visibly increases the borrower's interest expense, and substantially so the further LIBOR declines below 4.57%, reaching a maximum of 14.71% when LIBOR hits 0. These 3 sets of outcomes are now plotted on the graph appearing here in green, which should be self-explanatory. Note the difference in the angles between the upward sloping diagonal in green towards the middle of the graph and the inverted diagonal also in green towards the left when the company's net interest expense suffers from the exercise of the large short floor position by the bank. In the area close to the middle, this area here, the company is paying LIBOR plus 1% under the loan, and therefore benefits basis point for basis point from declines in the spot 3-month LIBOR level. Whereas, towards the left, this section here, the company is now short on a net basis, i.e. after taking into account the floors themselves, but also the exposure under the original loan, LIBOR floors with a notional of $200 million, and so finds its interest costs rising 2-for-1 from any further diminution in the 3-month LIBOR spot level. To confirm your full understanding of this example, we invite you to reflect on a strategy involving the purchase by the company of a 5-year LIBOR cap struck at 6.27%, and the sale of a 5-year LIBOR floor struck once again at 4.57% in a notional amount rounded to the nearest whole multiple of 100 million, sufficient to eliminate the premium for the bought cap. Your assignment includes the preparation of the summary table and of the final diagram illustrating the 3 possible outcomes. When drawing this final diagram, please show it on top of the diagram we drew for the last example. Click pause while you conduct this exercise. The 5-year LIBOR cap at 6.27% for a $100 million notional costs the company 193 basis points, while the 5-year LIBOR floor struck at 4.57% on $100 million notional earns the company only 27.5 basis points. It is readily seen that the notional of the short floor would need to be set to $700 million to generate an aggregate premium of almost 193 basis points for the company, thereby bringing the net premium to 0 more or less. The table summarizing the 3 potential outcomes appears next and should raise few surprises. Note in particular the need to sell as many as $600 million of additional LIBOR floors over and above the 100 million of floors that are, as practitioners would say, already covered in the sense of corresponding in notional amount to the loan's principal. And note also that as a result of this, the formula now turning red in the bottom row on the left, representing the situation in which the company suffers the consequences of having sold such a large amount of floors that have gone unexpectedly in the money, now has a multiplier of 6 instead of 2 previously, which of course will lead to a much steeper graph than before for the section on the left. This graph now appears in front of you in yellow and is shown along with the previous graph now appearing in green to highlight as well as possible the 2 key differences between these last 2 strategies. The new strategy provides the company with a lower maximum cost on its net interest exposure over on the right, where LIBOR is resetting at higher and higher levels. Here's leverage strategy 2, and here's leverage strategy 1. But the new strategy, leverage strategy 2, exposes the company to the risk of a steep increase in its interest expenses if 3-month LIBOR drops abruptly and approaches 0. This potential to incur large losses has made these leveraged option strategies quite controversial. After all, a borrower that has taken out a floating rate loan should normally be delighted to find LIBOR approaching Japanese-style levels close to 0, yet would find itself under the leveraged strategies having to explain to its shareholders and creditors why it is paying double-digit interest rates all in when much of its competition is paying almost no interest at all. In some of the more extreme cases, particularly ones involving U.S. industrial companies entering into massively leveraged trades in the early 1990s, a sudden and unexpected appreciation of US dollar LIBOR, along with a generic upward shift in most yield curves in G7 economies, resulted in losses of several dozen and sometimes $100 million for a number of medium and large-sized companies, directly resulting from the sale of substantial volumes of naked options on various yield curve plays and other interest rate views. Too often, these losses resulted in lawsuits against the bank offering the hedge on the basis that the company was not sophisticated enough to understand the risks it assumed, that it relied on the bank to advise it on the appropriateness of the hedge, and or that the bank failed to emphasize the downside scenarios and concentrated instead on the advantages of the strategy. Perhaps the most famous of all these involved a swap between consumer products giant Procter & Gamble and the long since vanished derivatives powerhouse Bankers Trust, in which the payment obligation of the company under its leg of an interest rate swap appeared likely under many circumstances to result in substantial savings for the company, but ended up generating a negative mark-to-market for the company of some $150 million after the 5-year U.S. Treasury yield had risen substantially, the price of the 30-year U.S. Treasury fallen substantially, and the company's payment obligation under the swap contained a clause requiring the company to pay, as you see in parenthesis, CMT5 over 576 minus P30 over 99, where CMT5 meant the yield of the 5-year U.S. Treasury, while P30 meant the price of the 30-year U.S. Treasury bond. Not a particularly scary formula, given the proximity of each numerator to its denominator, but one that becomes much more sinister when you are suddenly aware of the multiplier of 99 that appears in the final formula right before the term above in parentheses. The presence of such large amounts of leverage in this trade meant that a $100 million interest rate swap, whose maximum mark-to-market rarely exceeds 10% under the most volatile market conditions, in this case reached a mark-to-market well above 100% of the swap's notional, on account of what, once the trade had been analyzed exhaustively by market practitioners, was revealed to be a tremendously leveraged short exposure to complex embedded options on the yield curve shape and movement. It is perhaps not surprising that the bank chose to settle the lawsuit resulting from this situation by agreeing to settle the trade's unwind with P&G at only a small fraction of P&G's massively negative mark-to-market. Most financial institutions have therefore developed internal guidelines that restrict their staff from offering these types of strategies to their weaker or less sophisticated counterparts, and often impose additional criteria with regard to the minimum level of approvals that must be obtained before they will go ahead with such a trade, both internally for the bank structuring the trade and also for the client. And this is so even with the most creditworthy and sophisticated counterparts. Of course, defining precisely what strategies are deemed leveraged, or unduly risky, or complex is not an exact science, and institutions are often reluctant to adopt too simplistic an approach, such as one that would define leverage as involving any strategy in which a company sells options on a notional amount exceeding the notional of the underlying transaction. It is our view that any attempt to capture these types of trades via some written rule is bound to suffer from definitional imprecision and to give rise to opportunities on the part of overzealous financial engineers to find loopholes around the rules, and that the best protection the institution can achieve comes from inculcating a culture among its sales staff to think objectively about how capable the client is of understanding the risks of the strategy, and how financially able the client is to absorb the worst-case consequences if they materialize. And as always, frank, honest disclosure of downside scenarios, summarized in tables and graphs, goes a long way towards providing the necessary protection in the event of a subsequent lawsuit by an unhappy customer. This completes this chapter 4, as well as part 2 of this module on managing interest rate exposure.